take our conversation forward. Saurabh Mukerjea joins us now, and it's important that we understand his thought process, because everybody now seems to be making a very different view about how risk and reward now needs to be repositioned. Saurabh, there was a time when your thought process was getting rewarded by the market, whether it was identify good companies with good cash flow, or it was identifying companies which had a business moat around them. That same thought process right now is not working. High PE stocks are getting punished, and markets have a complete disregard for great franchises. How are you dealing with this cycle within a cycle?
Look, I don't think the correction in India or globally has that much to do with high PE. I know there's this perpetual perception that high PE gets punished, but it honestly doesn't show up either in the data. So whether it is Indian power and infrastructure stocks, or Indian consumer stocks, or Indian banking stocks, or indeed even in America, bellwether names like Microsoft or Walmart. It's a global pullback, and that itself gives us a clue as to why, at one level, yes, we should worry about it, but at another level, we should buy as much as we can in these circumstances, because the pullback that's happening in our market has very little to do with fundamentals. Our economy's outlook is the best I have seen in 12, 13 years. The banking system, for example, is in shape, I think, for 20, 25 years. So the pullback in India has got very little to do with fundamentals. The pullback in India has got everything to do with the fact that a lot of American investors have huge compulsions bearing down upon them. Their private portfolios, the unlisted portfolios, have been decimated in the last 6 months. In their public market portfolios, they're down 30%. And perforce, compulsion, from a compulsive perspective, they have to reduce their emerging market holdings, and we are part of that sell down process. Since the sell down is not taking that much regard of fundamentals, our job as sensible investors is to just keep a rational mind and keep buying the same stocks that you were referencing. High quality, high cash generative, great franchises. They are available even cheaper now than they were available 2 months ago. And we are buying as much as we can. And we're extremely thankful to the clients out there. They're continuing to give us inflows even in these circumstances, and we're taking full advantage of that every day.
What you're telling me is that you were getting on an average 100 crores when the things were going great. Your clients are not panicking, and if Asian Paints is going down, it is not because Marcellus is selling it. We can't blame it on.
So we are buying every day. We stopped getting 100 crores once the war began. The number now is closer to 50 crores a week, and that 50 crores, so roughly 10 crores a day, we are deploying in the various stocks that you and I have discussed over the years. And in some cases where the corrections are more severe, so for example, Dr. Lal is down, I think 30-35%. We're buying hundreds of crores of that over the last couple of weeks. So that has to be the job of a sensible investor, right? Our job is not to sort of become a macroeconomist when everybody in the world is pretending to be a macroeconomist and prophesying what the Fed will do, what will happen to global GDP and so on. Our job is to just keep a calm disposition and carry on buying great companies, especially since the macro outlook for India is the brightest I have seen for a long time. I'm not going to let that go. It's the brightest macro outlook for a long time. And we speak to a fairly wide range of foreign investors. Some of them are our clients. Some of them I'm hoping will become clients. And I can see the enthusiasm and the interest in the sheer amounts of time they're spending with us as they contemplate building out large Indian portfolios.
Good to hear that. It's so good to hear that. And I mean that. Saurabh, but when there is a reboot button which has been pressed in the world for interest rates, for assets, for risk, a lot of normals also change. And one such normal which is changing is the normal for the paint industry. I'm sure you've been asked this question because of Grasim's entry, what will happen to the paint industry? Let's understand that when a player like Grasim enters into a market which is largely a 2 or 3 player market, could this lead to war, or the pessimism is overdone?
So very little happens in business life which hasn't happened before, right? So It's not as if business history starts with the creation of Marcellus. And we've seen these cycles before. So if you sort of focus on the two different dynamics rippling through the paint industry today, first is the jump in the price of crude. So if you take this century, the last 20 years, there have been at least 3 occasions where in the space of 18 months, the price of crude has doubled. And each of these occasions, Asian Paints and indeed Berger Paints have held on to their gross margins and their operating margins because of the sheer strength of the franchises. With the lag of a few quarters, these companies pass on the raw material cost hike onto the customer base and protect their margins. That's the definition of pricing power. That's what a great franchise does, right? We've seen big ticket entries. So Sherwin-Williams, I think, entered 2006 or 7. The precise year escapes me. They burned through the best part of $1 billion in the space of 4 or 5 years, and they couldn't get to, I think, more than $10 million of revenues. This is the world's largest paint company. $1 billion back then is comparable to, say, a couple of billion today, which is roughly the number that's being mooted for Grasim. So we've seen this before. Plenty of people try to enter the franchises that our companies invest in, whether it's, say, Titan's franchise or HDFC Bank's franchise or Asian Paints' franchise. And because of the moats, because of the sustainable comparative advantages, those advances are thwarted, and our investee companies continue growing free cash flows at around 25%, and we continue compounding with them. That is the nature of investing, right? If it was so easy to build an Asian Paints, given that the company is 70 years, somebody else would have done it. If it was so easy to build an HDFC Bank, somebody else would have done it. If it was so easy to build a Titan, somebody else would have done it. These are extremely difficult franchises to build. And whilst their high PE multiples attracts competition, it's very difficult to replicate what these sorts of great franchises do. Couple of caveats: Marcellus is heavily invested in these names. I am heavily invested. My parents are heavily invested in these names through Marcellus.
Of Asian Paints as we speak has recovered. I would say advantage of watching ET now. You get the best right and the best analysis always live. Saurabh, I want to go back. Again, I'm taking the clock back. It's a slightly repetitive aspect of what we've discussed in the past. We've discussed that there are two companies within the pharma space. You've admired them for the accounting practices, pure disclosure. One is Cipla and the second is Divi's. I don't see any problem with the disclosures, but the problem now is earnings. Is Divi's going through a patch of cyclical downturn, or there is a challenge in what business category they are, which is largely centered around APIs?
I think Divi's earnings were firecracker earnings, right? Both the 4Q and the FY22 numbers. The sort of the concerns that the brokers express is that one of the reasons they had such stellar earnings in FY22, the broker says, was because of molnupiravir, and their point is that's a COVID drug, and hence demand could ebb off going forward. I suppose it could, but Divi's hasn't sort of been built on one drug, and my sense is that Divi's will sign up plenty other products. The relationship that Divi's has with the top 6 pharma companies in the world, I think, is unrivaled in Indian pharma. No other Indian pharma company has that strength of relationship with say, firms like Pfizer, like Glaxo, like Mylan. And I honestly don't have that much concern that Divi's will have a power-packed pipeline, given especially what's happening in China. China makes 10 to 20 times more API than India does. And my reckoning, there's a clear directive from the highest levels of American government to the American pharma companies to source more from India, less from China. And if there's one company that will make money on that redirection of API sourcing, that will be Divi's. So we, again, as you can understand, right, we are very delighted about the fact that people sold down Divi's on the back of this sort of brokerage research. We obviously wanted to capitalize on that. So it's a clear restructuring of global API sourcing lines against China in favor of India. And our deduction from that is this is in favor of Divi's, and therefore we remain buyers of Divi's on a daily basis.
Talked about your large cap portfolio, but I also want to throw in what's happening within the mid cap universe. Do you worry in this sell-off what's going to happen to your mid cap portfolio? You know, your favorite holdings, your GMM, Galaxy Surfactants, Garvare, etc. How is it that you're protecting capital there?
Ironically, the mid-cap companies, both in terms of before the war started in Russia, and even after the war started, that portfolio has held up actually better than large cap. The main reason for that is these sorts of companies, right? Galaxy, GMM, Garware, these are say $1 billion, $2 billion companies. These spaces are not large enough, Aisha. These spaces are not large enough to attract the attention of India's big ticket promoters or the attention of say the venture capital backed players, right? And because $1 billion in India is such a large economy now, $1 billion space, a $2 billion space, very few people seem to get worked up about it. And as a result, for example, it's how will you compete with a Garware Technical, which is the world leader in fishing nets for salmon aquaculture, right? A very niche spare, very specialist expertise, and hence nobody tries. And Garware's their ROCs keep going up year upon year. Similarly, GMM Pfaudler, how will you compete with that company? 85% market share in India, 55% globally, a 100-year-old firm really with the acquisition of Pfaudler. It's very specific, very niche expertise. And because these niches are so nicely insulated from competition, and they're sort of large but not so large, we carry on sort of peacefully compounding away. Our Little Champs portfolio has compounded at roughly 30%. It's now going to hit its third anniversary in a couple of months' time.
Well, we will be having our 13th anniversary very soon. You'll be having a third anniversary. So the difference is 10 years. So if you have to make a anniversary portfolio, Saurabh Mukerjea, valid for next 10 years, which is when we will celebrate our 23rd anniversary and you'll celebrate your 13th anniversary, what would you like to buy in that portfolio?
I think you'd asked me before 6 months or so, there's 3 Indian companies that I thought would become $1 trillion in 10 years. And I had sort of very safely and very conservatively, and I'm very confidently then and confidently now, I'll give you the names of 3 Indian companies, which I think have it in them to become $1 trillion companies a decade hence. So TCS, HDFC Bank, and if I had to pick out something else from, because TCS, HDFC Bank is a relatively safe bet because they're already north of 100 billion. So hitting $1 trillion 10 years hence will not be so tough. If I had to pick out a third name, I would go for Titan. We're the world's biggest market for jewelry. Titan is $50 billion, and I think looking good for another 20 years of stellar compounding. It's compounded at 30% for the last 20 years, believe it or not, both in cash flows and in share prices. So here's hoping that Titan continues its stellar performance for everybody who's watching this show.
Saurabh, what you've given me is the portfolio allocation for your big portfolio, Kings of Capital Allocation. You also have a Little Champ portfolio. So I was looking for a Little Champ portfolio for 10 years.
So let's try that. So GMM Pfaudler, I think the management has done a terrific job in taking a small Indian company and turning it into a mini multinational. I think whilst I'm sure they will face execution challenges on this path to becoming a global leader. I think so far Tarak Patel and the team have executed well. So we think they can last the distance and become a global leader in glass-lined ceramic reactors. Alkyl amines, market leader in aliphatic amines in India. As we just discussed, the API industry is coming to India. Alkyl amines is a natural beneficiary there. And amongst our little champs, if I had to sort of choose one more, I would put Fine Organics, market leader in emulsifiers. More generally, I think the food additive space is an industry where Fine Organics has it in it to do well. Obviously, these companies are small, say roughly $1 billion market cap, but their compounding and their fundamentals are stellar. And therefore, we look forward to many years of happy compounding with these little champs.
Saurabh Mukerjea, that's why we like calling you on ET now. Look how our next 10 years are sorted. I mean, not all the viewers and investors here. Okay. Good speaking with you as always, Saurabh. Okay, that's the view coming in from Saurabh Mukerjea. He's given you short-term as well as the long-term view on the apt portfolio that he's built for our ET Now viewers, both large caps as well as mid caps. On that note, we'll take a very quick break. The recovery in the market stays, by the way. We are at 15,800 now. And the breadth as well has made a very nice comeback. Mid cap IT, pharmaceuticals and Delta Corp. They are your high flyers this morning.